Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Understanding Budgeting Fundamentals. Understanding the fundamentals of budgeting is crucial for aligning financial planning with organizational strategic goals. Budgeting serves as a pivotal tool for decision-making, resource allocation, and performance evaluation within organizations. It establishes a financial framework that supports strategic initiatives and ensures resources are utilized efficiently to achieve desired outcomes. This lesson delves into the essential principles of budgeting and their integration with organizational strategic goals, illuminating the interconnectedness of financial planning and strategic management. Budgeting begins with the establishment of clear objectives that reflect the strategic goals of the organization. These objectives guide the budgeting process by defining the desired outcomes and setting the direction for financial planning. The objectives should be specific, measurable, achievable, relevant, and time-bound to provide a clear roadmap for the budgeting process. For instance, if an organization aims to expand its market share, the budget should allocate resources towards marketing, research, and development to support this goal. The next step in the budgeting process is the identification and estimation of revenues and expenses. Accurate revenue forecasting is critical, as it forms the basis for determining the available resources for expenditure. Revenue projections should be based on historical data, market trends, and economic indicators to ensure reliability. Similarly, expense estimation involves identifying all costs associated with achieving the strategic objectives, including direct costs, indirect costs, and contingency reserves. For example, a manufacturing company planning to launch a new product must account for production costs, marketing expenses, and potential risks in the budget. A fundamental aspect of budgeting is the classification of expenses into fixed and variable costs. Fixed costs remain constant regardless of the level of production or sales, such as rent, salaries, and insurance. Variable costs, on the other hand, fluctuate with changes in production or sales volume, such as raw materials and sales commissions. Understanding the distinction between fixed and variable costs allows organizations to manage their cost structure effectively and make informed decisions on resource allocation. For instance, during periods of low demand, an organization may focus on reducing variable costs to maintain profitability. Another critical element of budgeting is the development of a cash flow budget, which tracks the inflow and outflow of cash within a specific period. Cash flow budgeting ensures that the organization has sufficient liquidity to meet its obligations and invest in strategic initiatives. It involves projecting cash receipts from sales, investments, and financing activities, as well as cash payments for operating expenses, capital expenditures, and debt servicing. Effective cash flow management helps organizations avoid liquidity crises and take advantage of investment opportunities. For example, a company with a positive cash flow can invest in new technologies to enhance its competitive advantage. Budgeting also involves the creation of various budget types, each serving a specific purpose in the financial planning process. The operating budget, which outlines the expected revenues and expenses for day-to-day operations, is the most common type. Capital budgets, on the other hand, focus on long-term investments in assets such as property, equipment, and infrastructure. Special project budgets are developed for specific initiatives or one-time projects, providing a detailed financial plan for their execution. By utilizing different budget types, organizations can address both short-term operational needs and long-term strategic goals. For instance, a healthcare organization may use an operating budget for routine medical services and a capital budget for building a new facility. The integration of budgeting with organizational strategic goals requires a collaborative approach involving various stakeholders. The budgeting process should engage managers from different departments, ensuring that their input aligns with the overall strategic objectives. This collaborative approach fosters accountability and ownership, as managers are more likely to support and adhere to the budget if they have contributed to its development. Moreover, involving stakeholders in the budgeting process enhances the accuracy of revenue and expense projections, as they possess valuable insights into their respective areas. For example, the marketing manager can provide realistic estimates of promotional expenses, while the production manager can forecast manufacturing costs. Monitoring and controlling the budget is an ongoing process that ensures adherence to the financial plan and allows for timely adjustments. Regular budget reviews and variance analysis help identify deviations from the planned budget and their underlying causes. Variance analysis involves comparing actual performance with budgeted figures to assess whether the organization is on track to achieve its strategic goals. Positive variances indicate better than expected performance, while negative variances highlight areas requiring corrective action. For instance, if actual sales fall short of the budgeted target, the organization may need to revise its sales strategy or increase marketing efforts. Budgeting also plays a crucial role in performance evaluation and incentive systems. By establishing clear financial targets, organizations can measure the performance of departments and individuals against these targets. Performance-based incentives, such as bonuses and profit sharing, motivate employees to achieve budgetary goals and contribute to the overall success of the organization. Additionally, budgeting provides a basis for benchmarking and comparing performance with industry standards or competitors. For example, a retail company can benchmark its budgeted profit margins against those of leading competitors to identify areas for improvement. In conclusion, understanding budgeting fundamentals is essential for integrating budgeting with organizational strategic goals. The budgeting process involves setting clear objectives, forecasting revenues and expenses, classifying costs, developing cash flow budgets, and creating various budget types. A collaborative approach engages stakeholders and enhances the accuracy of financial planning. Ongoing monitoring and variance analysis ensure adherence to the budget and allow for timely adjustments. Budgeting also supports performance evaluation and incentive systems, motivating employees to achieve financial targets. By mastering these budgeting fundamentals, organizations can align their financial planning with strategic goals, ensuring efficient resource allocation and achieving desired outcomes. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.